Now let's compare the fair value through net income and the equity methods using this one purchase. So in this case, we're going to put it right on that borderline. We're going to say exactly 20% and then make you do a judgment call. Do we have or not have significant influence? So as a long-term investment, Painter's Equipment Company purchased 20% of AMC Supplies Incorporated's 490,000 shares for $570,000 at the beginning of the fiscal year of both companies. Not really. That matters only for the net income and the net income purposes. If you do not hold it for a full year, then you don't have full rights to all the year's income. On the purchase date, the fair value and the book value of AMC's assets were equal. During the year, AMC earned net income of $340,000 and distributed cash dividends of 20 cents per share. At year end, the fair value of the shares is $604,000. Assume no significant influence was acquired, or we've elected to use the fair value through net income method. Prepare the appropriate journal entries from the purchase through the end of the year. All right, so let's see what we would do here. We go in on January 1st. We would record this initial investment on day one. So we do investment in equity securities, or equity affiliate in this case, whichever one makes sense. We have no significant influence, so we're going to use equity securities because we're not recording this under the equity method. We're going to go in and hit our purchase price. We paid $570,000, so that's going to go in, and we're spending cash of $570,000. So that's step one. We got to get the investment on our books. Again, just like before, this is an asset exchange when we buy investments. No revenues or losses. We do have an outflow of $570,000. Excuse me, about $750,000. About to transpose those numbers, and this is an outflow from investing activities. Now, again, under the fair value, no significant influence, fair value through net income, we do not do any entry for the income. We only do that in the equity method, so we're not going to record any portion of their income on our books. We will have to record the dividends. So we're going to go in just like before. We're going to hit cash because we're going to receive them, and we're going to hit our dividend revenue. I think I didn't put the S on there, so there we go. Now the question becomes how much? Well, here you have to sort of be careful because it tells us that 20 cents per share. It doesn't tell us the total dollar amount, so we can't just do the 90 or the dividend times the 20%. So what do? Well, we know they have 490,000 shares and we own 20% of them. So step one, figure out how many shares you own. So 490,000 times the 20% tells me I own 98,000 shares. And we're going to take that 98,000 shares and we're going to multiply that by our 20 cents. So really you're times 0.2 times 0.2, which is sort of annoying, but that's what it is. So the first 0.2 is you own 20% of 490,000 shares. So that's going to give you 98,000 shares that you own. And then the dividend is 28 cents or 20 cents per share. So 98,000 shares times 20 cents per share would give us a total dividend of $19,600. And that would be our portion. So our assets are going up 19.6 and our equity is going up 19.6 because dividend revenue. In this case, our revenues go up. When revenues go up, so does our income. Typically speaking, this is an inflow. Well, it's always an inflow when you receive dividends. When you pay them, it's an outflow. And in this case, it would be operating because typically speaking, dividends would be operating. Now, at the end of the period, we do have to mark this to fair value just like before. So the fair value is $604. We paid $570. Therefore, our value has increased, so we're going to show, like before, a gain here. So we're going to debit our fair value adjustment because we've got to increase the value of our assets from $570 to $604. So $570 to $604 would be $34,000. And we're going to record a gain on investment. Now, just for understanding purposes, that's realized, but it does go into income just like or an unrealized, but it does go into income just like a realized gain would. For $34,000. So our assets are going up. We're increasing our assets on our balance sheet. Our equity is also going up because we're going to recognize that as income or revenue in our books, a gain on investment. That's part of our income. All right. No statement of cash flows when you do the fair value adjustment. Now, Let's flip gears. We've already done, this is our third example, so we sort of flew through that in just a few quick minutes. What if this were a significant influence situation and we needed to use or decided to use the equity method? We did not elect the fair value. We went with what GAAP requires as equity unless you elect otherwise. How would our entries change? Well, give you a hint, the first one wouldn't. When you buy the investment, you have to put an investment on your books. The only difference is some companies will record that as an equity affiliate instead of equity securities, just so that they can track which ones are equities versus which ones are lack significant influence. So it puts it in a slightly different account. But overall, you record the investment and you record the cash payment. Everything else is pretty much static in that. All right. Now, under the equity method, we must also record our portion of the net income. Think about the name of this method, the equity method. In theory, if we own 20-50%, we own that portion of the investee's income. So when they report income for that period, their equity goes up. So if their equity goes up, in theory, so does our portion of the ownership. I'm hoping that's sort of making sense. So if you were to look at the company we invested in, so who did we invest in? Let's go back up here. We invested in AMC Supplies. So we own 20% of that company. So in theory, as an owner, when AMC Supplies equity goes up, so should our investment. So under the equity method, we're going to record the changes in their equity as part of our investment, because if they increase equity, our share of the ownership goes up in that case. So we're going to show that net income. Net income increases equity. In theory, the owners own the net income. So when that income goes up, so does our investment. So what are we going to do there? Well, first and foremost, figure out how much. One here, they reported income of the year of $340,000. Keep in mind that's the total net income, and we only own 20%. So let's see, 10% would be 34, 20 to be 68,000 would be our portion of that income. So in theory, our ownership increases by 68,000. So we're going to go in and we're going to increase our investment in the equity affiliate for that 68,000. And then we're not going to record a cash. We're not getting a payment here. We're just simply showing it in our income statement. So we're going to hit investment revenue. We're actually going to show this as part of our income for the period since we own that portion of this company. So how does that impact our balance sheet? Well, our assets are going to go up 68,000 through the investment. Our equity goes up 68,000. In that, we're showing this as revenue. So our revenues go up, as does our income. Notice there's no statement of cash flow because we're not actually receiving a payout. That would be a dividend, which we're going to look at here in just a moment. So no cash flows impacted. Now, when we go to record the dividend, notice dividends are allocations of earnings to owners. Well, we've already reported our portion of the investment revenue. So if we go in and do dividend revenue again here, we're going to double count it. We're going to show one, we've received the 68 or didn't receive it, but we've recorded the 68, and then we're recording the dividend as if they distribute it. Also, think about what dividends do to the investee's equity. Well, when a company pays out dividends, their equity is actually reduced. It goes down. So when we go and do this, we're actually going to reduce our investment instead of recording it as income because we've already recorded our portion of the earnings of this company. So we're going to hit our equity affiliate here for the 19.6. We've already figured out our portion of the dividend because we did it up top. We know it's 19.6. Now we're still going to receive cash of 19.6. You're like, wait a minute, we should record it as revenue. We already have. So here they're simply allocating the earnings to us. We've already recorded our portion of the earnings. So if we were to report dividend revenue and investment revenue here, we're double counting our equity. So dividends reduce their equity. It should reduce our investment as well, is another way to think of it. So what's going on here? Well, our assets are going both up and down. It's an asset exchange. We're taking them up in cash. We're bringing it down in the overall value of the estimate, or excuse me, the dividend here. And statement of cash flows, this is an inflow of 19.6. And typically speaking, dividends are operating, so it's an inflow from operating. However, dependent on the type of dividend, you may have an investing activity right there. So it is possible when you have the equity method for this to either be operating or investing. And then under IFRS, there's a good case for it to be investing. IFRS sort of follows the trail, so typically a dividend would be investing under IFRS in that case. All right. Then the fair value adjustment. Well, under the equity method, it's based on our ownership of the company. So therefore, when we actually go at year end, we do not adjust for fair value, because the fair value of the stock doesn't impact their actual overall equity of the company. So we don't worry with that. So we would not do a fair value adjustment under the equity method. Okay. All right. So that's sort of the differences in a nutshell. Under the fair value, you do not record, and the dividends go into dividend revenue, and you must mark to fair value. Under the equity method, as the company we've invested in's equity changes, so does our ownership. So when they report income, we take our portion of the income and record it as investment revenue. However, the dividends, since we've already taken our portion, when dividends reduce their overall equity, we just simply go against our investment to show that our ownership has been reduced in that company. All right, if you have any questions, let me know. Otherwise, have a great day.